This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, in this chapter we're going to look at the way the management accountant will record transactions. And there is more than one way of dealing with it, but what you're required to be aware of is what we call integrated cost accounting, where the management accounts are dealt with at the same time as the financial accounts in the same books. Now, a slight problem is that it's in paper BA3 where you need to go through all the double entry and understand debits and credits. And if you've already studied that paper, then you'll already be aware of them. In this exam, management accounting, it's only one little bit of it that's needed, and I'm not going to teach the whole of debits and credits. Again, if you've done BA3, then it'll be absolutely no problem. If you haven't, then I'm afraid it is very much just learning the rules, but there aren't that many involved here, and it's not likely to be many questions in the exam either. However, having said all that, before we get into the actual accounting, I do need to say one thing about labour. I think you've already seen that labour can either be direct labour, that's where they're actually working on the goods, they're actually producing the goods, or it can be indirect labour. Indirect labour, things like supervisors, who are cost of production. We're talking about supervisors in the factory. I should have put for example. No, they are in the factory supervising the workers, but the supervisors themselves aren't actually producing anything, and so it's indirect labour, and that is an overhead. Now, we've already had that, so no problem. Direct labour, they're actually producing. Indirect, again, they're in the factory, but they're not actually producing anything. However, one more thing about the direct workers, and it relates to things like overtime. And you'll see there, I'm not going to write the whole sentence on the screen, but those workers who are directly involved in making products, which is usually direct labour, their basic pay is a direct cost, and so is any overtime that's paid them, if it's specifically at a customer's request. So that's classed as direct labour. However, even though they're workers making products, any general overtime premium, so any extra we pay them for overtime, any bonus payments, any payment for idle time, you'll remember from variance analysis, idle time is when they're not actually working, and any sick pay, well, even though they are our direct workers, any of those payments listed there are treated as indirect as an overhead. Now, just make sure you understand a bit about overtime premium. Just let me give you a little example. Suppose our direct workers work this week, let's say 60 hours, of which 10 hours are general overtime. It's not at a customer specific request. They normally work 50 hours. This week they've worked 60 hours, 10 hours are overtime. Their basic pay is $10 per hour, but for overtime they're paid $15 per hour. And so they paid an extra $5 an hour. That extra $5 is what we call the overtime premium. Well, the direct workers, but when we come to classify the direct labour, is their basic pay. So they worked 60 hours. The basic pay is $10 an hour, and so the direct labour is $600. They were actually paid more than $600, of course, because for 10 of those hours, they were paid an extra $5. Well, that extra, the overtime premium, is treated as indirect labour, and therefore part of our production overheads. And how much extra were they paid? 10 hours, the premium, the extra $5, is $50. And so that's how much they paid. I mean, if you're at all worried, don't forget, 50 of the hours were just paid the normal rate, $500. The other 10 hours were paid the higher rate, $150. So in total they paid $650. But the normal pay, $10 an hour, is direct labour. The premium, the extra for the overtime, is indirect. Okay, well, I just wanted to mention that. However, let's now look at the accounting entries. And without having a great long chat out at the beginning, again, if you're studying or you have studied BA3, the debits credits here are very easy. If you haven't, I can't give a full financial accounts lecture here. If you haven't, then just see the rules. And it's only what I do here, really, that you can be asked. Look at example 1. ABC produces and sells product X. The standard card is as follows. So materials, you've seen standard cost cards before, 75 a unit, labour 30, variable overheads 15. The standard cost, its marginal costing, is 120. The standard selling price is 200. During January, they produced and sold 1,000 units. And below, you've got the actual results. The sales, total 200,000, materials 77, labour 35, other variable overheads 10. There were no opening inventories, all expenses were paid in cash. And there is that little note there that for whatever reason, 5,000 of labour was indirect. The rest presumably was direct. And direct labour worked for 10,000 hours. All right, let's go through and record. First of all, let's record what actually happened. We sold goods for 200,000. Well, we have accounts for each thing, so it says everything here is for cash. And so I have a little account where we'll record all the cash received and paid. And a little account will record the sales. And the rule is when we receive cash, we put it on the left-hand side of the cash account, which we call the debit side. The other side we call the credit side. So we recorded we've got the cash. We also, in the sales account on the opposite side, record the fact we've made sales. Let's carry on though. We spent 77,000 on materials. We spent money, so we put it on the other side of cash, 77,000. That records with less cash. And we'll have a materials account. and we'll put it on the other side. That records that we've spent money on materials. And in exactly the same way with labour and with overheads. So labour, we actually spent 35,000. We put it on the payment side, the credit side of cash. We've less cash. And we'll have labour account. And we'll put it on the other side. That how much was it? 35,000. So we've recorded how much we spent on labour. Finally, the variable overheads, 10,000. In exactly the same way, we'll credit cash because we've less money, and we'll debit our production overheads account. The opposite side. Keep forgetting the amount, 10,000, to record the overheads. So I've now recorded everything. I've got a note here of what the sales were and what each of the expenses were: materials, labour, overheads. Next, though, remember that little note at the end that 5,000 of the labour cost was indirect labour. And so the 35,000 we paid, 5,000 is actually an overhead. It's not direct labour. And so we need to take 5,000 out of labour. I'll put 5,000 on that side. And give it instead to overheads. So it means all we've got left on labour shortly is 30,000. That's the direct labour. And the overheads have now gone up to 15. The overheads we were told about, plus the indirect labour. Now we say, right, now we've got a record of what we spent on materials, labour and overheads. But of course, we put them all together to form the cost of what we sold. And so I'll have a cost of sales account. And let's move everything to get the full cost of what we produced. So materials, remove it from materials, put it on the credit side, the right-hand side, and I'll debit the cost of sales account. So we now finish with the materials account. Similarly, labour. Appreciate there's only 30,000 left. So I'll move it from labour and put it on cost of sales. And I'll finish with the labour account. And similarly, overheads. 15,000 in total. Take it, remove it from there, and give it to the cost of sales. And so cost of sales is what we've spent in each of our three normal categories: direct materials, direct labour and overheads. Incidentally, in real life, you'd actually first put them all to a work in progress account, because that's the cost of everything we're actually working on. But there could be at the end of the year some items which are only part finished and aren't ready for sale. However, the examiner said he won't test you in this bit on work in progress, so I didn't bother. We've put all of that. There's the cost of everything we've produced. No problem. So where am I? I know how much revenue we got, 200,000. I know what the cost of everything was, the production, the total of all those. And so let's now start to produce our statement of profit or loss. Put a little account for it. However, when we put things on the statement of profit or loss, the sales, the cost of sales, we put them at standard prices. So first of all, the sales. Forget what we actually received to the moment. What should we have received? We sold 1,000 units. The standard selling price is 200,000. So there's no problem. We spent the right amount, or received, I beg your pardon, and we move it to the statement of profit or loss. 200,000. So I've finished with that account. There's my total revenue. And it's correct, you know, it's a standard cost. A standard selling price, sorry. But where I do have a little problem is cost of sales. I want to put that to the statement of profit or loss, but forget what we've actually spent. What should we have spent? Now, we produced 1,000 units. The standard cost, look at the cost card, is 120. And so we move the standard cost to our statement of 120,000. And so that's what should have happened. Sales at standard selling price, cost of sales at standard cost, and therefore the profit should be the difference of 80,000, the standard profit. Standard cost 120, standard selling price 200, and the revenue, the standard profit 80,000. And again, that checks. Look at the question. Selling price 200, standard cost 120. So standard profit $80 a unit. We sold 1,000 units, $80. However, we do have a little problem. Because if you look back at the cost of sales account, although we should have spent a total of 120, we didn't actually spend 120. We spent 77 on materials, 30 on labour, 15 on overheads. We actually spent 122,000. What went wrong? We should have spent 120. Well, let's check them. Overheads, look at the cost card. Overheads were supposed to be 15 a unit. 1,000 units, what did we spend? 15,000. Overheads, no problem. What about labour? Labour should have been $30 a unit. 1,000 units, we spent 30,000. No problem. But look, it's materials that have gone wrong. We should have spent 75 a unit. So for 1,000 units, we should have spent 75,000. We actually spent 77,000. Something's gone wrong. But of course, with a variance. We spent 77, it should have been 75. We spent enough time in an earlier chapter on variances. It's materials that are the problem. So I'll come back and finish these little accounts in a minute. Let's calculate the materials variances. And in fact, because this is revision, it might be an idea if you pause the lecture and did them yourself and then started off again. But let's do them. First of all, the price or expenditure variance. Remember, we take the actual purchases at actual cost. And compare with actual purchases at standard cost. Well, what did we actually buy? Look at the actual results. We actually bought 5,500 kilos. And in total, we spent 77,000. How much should we have spent? Well, for those 5,500 kilos, from the cost card, we should have spent $15 per kilo. We should have spent $82,500. So in fact, we've done rather well here. We've obviously paid a lot less than 15. We've saved the difference of 5,500. We spent less, we've saved money. It's favourable. The other thing we need to look at, if you remember, is the usage variance. For usage, compare what we actually used. Again, what was it? 5,500 kilos? With what we should have used for the actual production. Well, remember we produced 1,000 units, the actual production. From the cost card, it should have been 5 kilos a unit. We should have used 5,000 kilos. We've used too much, 500 kilos. And how much would that have cost us? At standard cost. The standard cost per kilo again, $15. And so 500 extra kilos, 15. Oops, dear, oh dear. 7,500. We've used more than we should have done, and so it's cost us more. It's adverse. So that's what went wrong. In total, does it check? In total, we spent 2,000 more than we should have done. And of course, that explains two things. It explains why we spent 77 when it should have been 75. It also explains why the total of all the expenses was 122, 2,000 more than the standard cost. And so finally, now we know what caused that 2,000. It's the variances. We put them in. We had a price variance and expenditure variance of 5,500, favourable. And so our favourable variance, we debit, we put on this side of the cost of sales. What was it? Expenditure variance. And we credit our statement of profit or loss. Materials expenditure variance. 5,500. Finally, the other thing that stopped it working was this usage variance. The usage variance. This was adverse, so we credit the cost of sales. And on the other side, we debit statement of profit or loss. It was adverse. So whereas the expenditure variance, which was favourable, increases the profit, the usage variance, which is adverse, reduces the profit. And now we've just about finished. Cost of sales should now add up. So this side adds up to Oh dear, 77 plus 30 plus 15 plus 5.5. 127,500, and the other side adds up to 127,500 as well. To explain the difference, here there was only the materials variances. Obviously in real life there could have been labour variances, overhead variances. We'd have dealt with them in the same way. And what about the statement of profit or loss? 80,000 is our standard profit. That's what we should have made. $80 on every unit sold. We've now put in the variances, and again in real life there could be the labour variances, the overhead variances, just as we did in the earlier chapter. But as a result, whatever the missing figure is our actual profit. That side adds up to 85,500. The missing figure, the balancing figure, is 78,000. There is our actual profit. And of course, although not here, but in general terms, we could now produce a little operating statement, which we covered, I don't know, 4 chapters ago, whenever it was, because we know what the standard profit is. We could list all the variances in a nice statement and end up with the actual profit. So there we are, integrated accounting.